Diversification is a key ingredient of successful long-term investing. You could then diversify with a number of means. You could adopt a number of method of diversification. And so in this video, I want to talk about why mutual funds are a great tool for diversification, particularly for new investors. So we need to ask ourselves precisely what is diversification? What is diversification? Diversification is the practice of spreading investment across different asset classes, industries, and geographic regions to reduce or mitigate risk. And not only that, it is aimed to minimize the impact of poor performance from any single investment on the overall portfolio. Should in case a particular investment underperforms, it will not have so much a detrimental effect on the entire portfolio. So I want to look at how to achieve diversification through mutual funds. How to use mutual funds to achieve diversification. Number one here is varieties of securities. Variety of securities. You will discover that mutual funds typically invest in a wide range of assets, including stocks, bonds, and cash equivalents. This broad exposure reduces the risk of significant losses from any one security. But the fact that you've invested your capital across different securities, should in case any single one of them underperforms, it will not really have an enormous negative impact on your overall portfolio. Number two is sector and industry diversification. Sector and industry diversification. And mutual funds often allocates investments across various sectors, example, technology, healthcare, finance, consumer staple, and many other sectors. So it helps mitigate the risk of downturns in a specific industry. In a case where a particular sector or industry performs poorly, the other ones will then be there to hedge against the poor performance of a single industry in the portfolio. Number three is geographic diversification. Geographic diversification. And many mutual funds invest in both domestic and international markets, offering protection against country-specific or region-specific economic or political risk. In the case where a particular country or a given region underperforms, your investment in other countries, in other regions, will then be there to cushion the underperformance of probably your country of residence. Number four is asset class diversification. Asset class diversification. Some mutual funds, such as balance funds, invest in a mix of asset classes. Example, equities and fixed income like bonds. And by so doing, they provide stability during market fluctuation. In a case where the market fluctuates, equity may underperform, but the bond market could still provide regular income through coupon interest to investors. I want to highlight the benefits of diversification through mutual funds. The benefit of diversification through mutual funds. There's a number one. There's a reduced risk. There's that reduction in risk level by spreading your by spreading and adjusting your investments. Mutual funds lowers the risk of large losses, making them less volatile than individual stocks or bonds. In the case where you invest in individual stocks or bonds, you are so exposed to volatility and risk and market fluctuation. But in a case where you spread your risk across different equities and different bonds, you discover that you are somewhat protected. Number two is professional management. Professional management. Fund manager selects and monitor a diverse portfolio, making it easier for beginners to achieve diversification without extensive knowledge. Usually, as a beginner, you may not have the knowledge level that would guarantee you success in individual stock picking. So you could kind of uh, use a mutual fund to invest. Apart from your little equity holdings, you could diversify with a mutual fund. And the professional management that is provided in the fund industry will go a long way in helping you to have a better results at the end of the day. Number three is accessibility. Accessibility. Mutual funds, allow investors to. It allows investors with limited capital to access a diversified portfolio that would be difficult to achieve independently. So it gives you an avenue for diversification. And besides, with little capital, you could invest in a mutual fund, and that will expose you to a wider range or a wider class, of assets, of different kind of assets. Number four is core efficiency, core cost efficiency, cost efficiency. So instead of buying multiple individual securities, investors can achieve diversification with a single mutual fund investment, savings on transaction cost. The lesser the number of securities you buy, the lesser your transaction cost. When you buy a single mutual fund, instead of buying many individual equities, you discover that you have a lesser transaction cost. In this case, you discover that mutual fund investment provides cost efficiency. We want to look at different types of mutual funds you could adopt for diversification, different kinds of funds you could use to diversify your portfolio. Well, one you have equity funds. Number two is bond funds. Number three is balance funds, and number four is index funds. Let's start with number one. Equity funds actually diversify across various sectors and market capitalization in the equities market, in the stock market, to diversify across different sectors, across different industries, and across different market capitalization. It could be small cap, it could be big cap, it could be large cap, it could be mid cap, different capitalization. Number two is bond funds. So in this case, you spread risk across different types of bonds. You have government bonds, corporate bonds, as well as municipal bonds. So through a bond fund, you can spread your risk across different kinds of bonds. Number three is a balance fund. Balance funds actually incorporates, it's a kind of a combination, of stocks as well as bonds for more stable, diversified growth portfolio. In this case, there's that element of growth through stocks and the element of stability through bonds. So balance funds provides this advantage. You have an index fund, that's number four. It tracks a broad market index, providing instant diversification across numerous securities. If you buy a typical S&P 500, you are diversified across, the 500 most capitalized companies in the U.S. stock market. If it's in Nigeria here, and you purchase the all share index, you discover that you are diversified across many stocks in the Nigerian stock exchange. So in conclusion, mutual funds offer an easy and effective way for beginners to achieve diversification by by investing in a professionally managed diversified portfolio. Investors can reduce risk while gaining exposure to various asset classes, various sectors, and even regions, enhancing their long-term financial stability. And so it's a very, very good investment for beginners. As you become more conversant with the market, as you become, skilled, more skills, more knowledgeable and skillful, you may decide to, invest the more in individual stocks. But for a beginner, you may equally incorporate mutual funds in your portfolio. Please subscribe to this channel and like this video if you've stayed all this long.